Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. I'm a member of the board of the Foundation, and once a week we meet here on Monday to review some cycles here in the Cycles TV weekly series. So if you are new to this session, we meet here once a week. I will review some current market data on cycles, and we will analyze mainly market data with our digital signal processing, focusing on the current status on cycles and learning a little bit how to apply the tools, how to use the tools, and how to do cycle analysis. While reviewing this, we are live today, so always feel free to drop me your questions into the chat sections down below so that I can have, at least at the end, a quick look on your questions, and I will try my best to answer most of your questions if they reference to our cycle analysis here. So thanks for joining me today. Nice to see you again here, and for sure congratulations to Italy for this nice championship we have watched last night, if you are aware of. So, but that's more personal note. It was a fun again to meet. So hello in the chat. Yeah, feel free to drop me in your location from where you are so that I get a feeling a little bit where we are here once we meet every week here. Okay, so what's in for today? In the last week, I talked a little bit about detrending, so more about the background of cycle analysis and a very important topic in regards to pre-processing of data. So today, let's review some main indices, main data sets, and have a look on what the current cycles tell us. So today, we do a basic cycle analysis session on main indice data sets for the next 15 to 20 minutes to have a short look what the main dominant cycles tell us. So therefore, let's jump into our cycle analyzer, which will you see here on our big screen here. So this is for some new starters here. This is what you will be able to use as a member of the Foundation, which gives you basic access to main data series and which allows you to open up our cycle scanner here. So therefore, let's do a quick walkthrough on the main markets in the market pool section, which summarizes or wraps up the main data set. So let's start with the commodities. You know, we've analyzed gold and silver quite often here. I think back in the beginning of June, it was the last time we met here around commodities. So let's review this for a second. So we will start with gold. Let's open gold in our cycle scanner here. So this is the gold series. You know that we had, I think the last time we did our session here, it was around this time here in May, beginning of June, and to be honest, where we, and the cycles helped us to approach the top and the low here. And I remember at this point here, we reviewed it, it was looking for that the upswing had not finished yet. But then, as this often happens, cycles are not 100% there all the time. So gold started to move down. So let's analyze what this means maybe. So in general, we see here on this data set that there is from the most important cycles here, if we just skip these short-term cycles here, this is the basic procedure. Look for the most prominent cycle, which has a high strength score and has a longer length, which is important then for the price movement, even if we are on a daily series. So we are not interested for the very short cycles here on the daily time frame. This is the one with the length of 170, which can be seen here in the spectrum, which clearly stands out besides the shorter ones here. So this is the first important one to look at. So let's select this cycle here. Yeah, and I think it's still showing us the same picture as we reviewed it here back in June. And let's highlight the situation here. So I think we saw the same situation here with this top here, then moving into this low, this top here, and then back into this low, and then we are following this up move here until this position here. And I think we monitored somewhere here in a live session here on the show on the gold, and I think it was looking that gold might still continue to move up, but it did do the other way around. So this is what we are looking at here today. So the main dominant cycle showed us we should peak or should have gone higher even the last 2 weeks, but we haven't. And there is one interesting feature that you always need to look at, which is in the configuration, in the post-processing, where you can switch which phase should be used for the phase detection of the length. So this will not impact the cycle length detection in the overall data set, but there are different ways to use the phase of the cycle. So last week I talked a lot about detrending, so let's use this example here to talk a little bit about the phase of the cycle here. So the normal setting is that it will use the average cycle phase, which is, by the way, the normal setting any digital signal processing will use. So therefore, this is the standard setting what we use here. What this means is it uses the full in-sample period, which in this case, the in-sample period is from here, so where the change between the light blue and the dark blue happens until here. So this is the in-sample period. And so once it detects the dominant cycle with a length of 170 days, it's then the phase of this cycle is aligned based on the full data set here. So this is called the average cycle length, which is the normal Fourier or digital signal processing. But there are there's a different way which can improve the cycle phase. Not always, and it's easy to talk about that in after the fact, but you should be aware that you are able to do this at any point in time. Often you are more interested, as you know, that cycles shift over time, which means the length and the phase, so it's never static. So even if you analyze this in-sample period here over the full time, and it looks like that this is a static cycle in regards to constant length, constant phase, this is for sure oversimplified. The cycle is not as static as suggested here. So the length might change and the phase might change. And this is always not easy if you have two parameters which might change over time. But that's the heavy stuff in regards cycles projecting. But the phase tells you where the low and highs are anchored in the data series. You can use, once you have detected the length, then you can skip, for example, some data in the past. What this means then, if we will just the current data for the phase detection, this means in this example, if we pick the current phase, it will skip the long past and will just use this period here for the current phase, while the other setting, which I talked about, is using the full length here, right? So therefore, while this will not impact the length setting, the red one is the average cycle phase, and the green one is then the shortened period of the data set, which will be used for the current phase. Because if you want to do a projection, you need the overall data set to detect the length because you should not shorten it below this 3 times multiply of the cycle you're looking for. But in regards to phase, you can then shorten the time period to look for the current phase. So that's what we do in the configuration. So first, I just wanted to explain what the difference here is in regards to these settings here. So this is the average phase, and you will now have a quick, I will cancel it here, have a quick look at this is how the cycle looks if we use the average phase on the full data set. So if we switch now to the current phase, which will skip some historical data long back in the past, because we are interested what's the current phase, so where is the current top and bottom aligned of this cycle. We don't need to average it over the full data set. We switch now to current cycle phase, and you will see that the length will not change, but the phase will slightly change. So I will update this. And you can see that in regards to aligning this cycle here, I will make it bigger, and I will switch now forth and back between both analysis. So this is the current cycle phase. I will now do the average. You can monitor how this switches slightly. So let's go back to the current cycle phase. Okay, so that's the purpose, or that's what happens if you switch the phase detection. And what we see now is that this tells us that it looks like the phase has translated, or the top seems to have arrived already here at this point. So you see now that this cycle is more closely aligned to the current market behavior instead of using the overall data set. So that's the difference in current phase to overall phase. So you see the length has not changed. It's the same cycle with the length of 170 days. Yeah, just switching the phase detection to the current behavior. So and you can clearly see that this is now almost perfectly aligned with market behavior. And that's the difference if you use the average phase or the current phase. And let's go back just in time to see if we would have been able just ahead of time at the end of May or beginning of June. I don't know. So I'm just doing this live together with you here. So therefore, we will now switch the anchoring of the end of the analysis. We will do this by clicking here on this right symbol here, and we will set the end of our analysis short before the end of this upswing here. So let's put it here. Let's update the cycle analysis. And now we see this is the in-sample period before the gold turns down at this is now end of May. So we will have the same cycle here. This the length of 172 days, which is still the same. And now let's look what the cycles tell us if we use the different configuration. So this is the current cycle phase. So it will not help us here. So and switch to average cycle phase here. So therefore, it would not help us ahead of time. So this is, so to be fair, once we have the new data in, we can switch or we can realign the phase to current market behavior. Ahead of time, this would not have been possible because the top was not in. So therefore, it's easy to talk about. I'm not sure if what's the better way. So I just want to explain you can switch between two procedures, the current phase, cycle phase. I think in this case, there is nothing to align the phase to for the current market behavior. It still suggests, this is, and then we have gone off here for this cycle. So therefore, we can't trust this forecast anymore if we add the additional data. And if we update it now to including the latest data, we will see that the cycle length is going to 170, but we see now that the phase has shifted. So that's the that's also the problem or the shortcomings of cycle analysis. So as we are talking here about cycle analysis, we cannot always predict everything with cycles as cycles shift. And in most cases, you only know the shift after the fact. So forecasting the dynamics of cycles, this is now an uncharted territory, which we need to do research and analysis. So I think to detect the cycles in the market, this has been solved. Yeah, this question has been solved. We can do this. The key is that you are able to learn to differentiate, can I trust this cycle? Yes or no? And I think we provide some figures and statistics and a Bartels score and visual validation with spectrum and other data sets. That's what I try to show here once a week, so that you will learn to understand when to trust cycles and when not to trust cycles. And then the third step is, and this is an example where even our knowledge might not help us in advance. So the final step is we need to research and find answers on how can we better spot the dynamic behavior of cycles in advance. Yeah, I mean, this example showed it after the fact, which is nice for cycle analysis or doing research. I mean, that's the main purpose for the foundation. That's not nice if you do, or if you base your trading just purely on cycles, but it's also a good example that you should not do this. You need to add additional methods if you want to be successful in trading anyhow. And I think this explains a little bit at least the difference on the cycles here, which happened live on gold. But okay, let's not overstress this example. It's just to talk a little bit about that. Let's move on. Let's review some other current cycles. So for example, in the crypto area, I did a very long analysis on Bitcoin versus US dollar in our financial cycle summit. So let's do a live update on this here on the Bitcoin data set. I think it's anyhow a hard period right now. It's more or less moving sideways here for a long time, around 30,000 something. So no real movements here. And let's see what the current cycle tells us. Please review the financial summit if you're interested in the longer forecast. But anyhow, if we just look at the current behavior, we have two interesting ones. One is with a length of 200, which is a very important cycle if you review the history of cycles in the Bitcoin data set. And this is what I did in the summit. So therefore, and this is one method that you get a clue on which cycle could I use from this spectrum. I mean, if you just have a first look at this without understanding the history of cycles in this data set, it would be hard to use. If you had done your homework over the longer history of Bitcoin, you know that we can use the 200-something cycle. And then this shows up as a new prominent cycle here. So these two ones are worth to have a look at. Let's start with the 200-something. Yeah, and this it gives us still the same picture which I reviewed in the financial summit. So if history repeats on the pattern which we have reviewed in the summit, we are waiting for a final dominant up push in the cryptos, which is here. So this is the count of 5, which I told here. It's still in alignment with the current cycle projection here. So there's no new update. We can now check in our analysis in regards to current cycle phase or average cycle phase. So the current cycle phase, it's still the same. So here you see no difference, even if we choose current or average cycle phase. So this is what I recommend to you. Switch between these two options. If you see no difference, it seems like there is no difference in the average and the current cycle phase here. So this is the 205-day cycle, and now there is this longer cycle also in the mix. You can do a composite, or we can analyze this also alone. And it shows, at least from the short-term perspective, it shows us a similar picture. So even though this is a longer cycle, but you see from the phase, the top is more aligned to the left. So we are still in the bottoming phase until August. And then this is also suggesting an uptrend. So both cycles which stand out in the current analysis, so this one here with the 205 and this one with the 288, from their current phase alignment, we are now coming into a period, I think, mid of July, so in 2 weeks, these two cycles get an alignment of their phase. So the cycle with the 288 days is switching from the current downtrend here in the upswing, which will then join this cycle here, which has already shifted to the upwards here since end of June. So, and by mid-July, this is the point in time here. By mid-July, this is where we are in the shorter term cycle, and at this point in time, also the longer term cycle will then switch to the upswing here. So after mid-July, both cycles project the upswing, and this is what we need to wait for, because this longer term cycle from the current status quo has still some room to go here. So this is, we are still in the final down. So the longer term cycle is still pointing down, while it's not shorter, but the 200 is still pointing up. In theory, this is a very nice explanation for the sideways move, which we see here. So, okay, so it would be interesting once we arrive in the second half of July, and this is the combination of both cycles here. So both cycles then join their upswing here. And this would be interesting to watch out, as this also fits into the overall pattern of Bitcoin for the longer historical analysis on cycles here. Okay, so there's no change in that. I just have a close look on your questions here, and Jason, the indexes were phase aligned with the 175-day cycle pattern for a while. Now they seem to be diverging. Can you compare the detected dynamic cycles were more fixed like Hearst? I mean, let's get back to the dashboard, or what we've seen in the index. The cycle with a length of 170 something is a cycle which showed up for not only this year, also last year. So I explained that the 170 cycle is visible in the main indices for a very long time. However, the rhythm has gone out of sync since end of last year. So and I agree, they have anyhow been aligned on that. So if we can even use the German DAX for this, which is still in the 170 something here. So it's 200 now. Let's think we need to so this analysis, or the analysis you see at the dashboards, is mainly aligned on trading days or weekdays. So therefore I just changed the analysis, and here we see also in the German DAX this index here, and this is what I meant. We've gone out of sync, at the end of last year. I mean, now in this backward analysis, it looks interesting, but this sync was, at this point in time here, I think we have been irritated. And this midpoint of this cycle, this is always interesting here. So at this midpoint where we had the top in here, yeah, if you see this here for a second. So therefore this cycle was good until the midpoint, and then it switched. Then market moved up, but cycle still projected to go down here. So therefore this period was out of sync. So therefore this is what I meant when I said the cycle with a length of 170 something has gone out of sync at the end of last year. Sorry for this maybe not the nicest analysis. So let's review this. And I'm observing this since, or we talked about this since end of last year. Yeah. So here we nicely followed this cycle, by the way, for this whole period here. The cycle was very helpful before we reached end of 2020 here, somewhere in September, November, and it very nicely projected this high here again, and then until November, all fine until this point in time here. Yeah, and you see this is the midpoint cycle here, and after that, the markets moved up here, while the cycle still pointed down until here. And this was not a nice period of time, because this is when you get a headache doing your cycle analysis from here to here. We had a divergence of a cycle projection and market behavior. So and let's update this to today. So then we could argue that okay, so that even here we had the divergence for this point in time. So then we had the next upswing, which could happen. So if we skip a kind of period in this cycle, then this cycle will realign after some point of time, because this is a very strong cycle of 170. But this suggests, and this is what you should analyze on the daily data, this suggests that since end of May, the markets have been suggested to top from this dominant cycle here, and they still continue to move higher here. And this is the next divergence we have now into play, at least since May. So for the last 4 weeks, we still see or you can count this as a sideways moves here, while this cycle is pointing down. So there are now different, and therefore, Jason, I would recommend. So we need to take into account longer series, so the weekly series needs to be taken into account, and we need to correlate maybe different markets. So for example, the technology index or the, oops, no, I don't want to have this view here. So let's review this on the Nasdaq, so the technology data, and that's first of all to have the same time scale here. So here it's shown as a cycle with a length of 160 something, which peaks out here. It's the same, so it's still 170 something. This is what I always tell. So we see the same cycle length, the nominal cycle length, what Hurst would call it. It's just then from the dynamics, it's morphed into a cycle with a length of 162. And you see here, it's diverging in regards to phase alignments here. So here again, but I just can confirm what you mentioned. So the dynamic behavior of these cycles is diverging now between different markets. So there's not a clear picture of cycles aligning between different markets here. I'm Jason, just confirming what you said. I think there's no clear answer if static cycles are better or dynamic cycles here. This is just cycle analysis, and in regards to what will have the best projection we don't know beforehand. And this is maybe the final piece of the puzzle which needs to be solved. We need to get a clue on the dynamics of cycles before the fact. I mean, we don't have it yet, but this is why we are the foundation for the study of cycles, and still looking for that. Once we have found an answer, for sure you will be the first one to talk about. Yeah, okay, so we did Bitcoin, we did gold, we did the German DAX index and the Nasdaq. You see it's maybe a little bit diverging, so maybe to close for today, let's always have a view on the S&P 500 here. which this I think, I don't know who can explain this straight move up here. It seems like never-ending up series. Maybe we are on the wave 3, what Elliott wave or logicians would call this. You don't know when this ends, and don't go against it here. Nothing works in a wave 3, but I don't know. I'm not an expert in Elliott waves here. Let's look at the cycle. So we can use the same here, switch it to weekdays to have the same scaling as we had in the other data sets, just from the links. And here again, you see again the prominent cycle with a length of 174 days. So we see this in more or less all markets here. And what we are seeing here from the alignment of this cycle, quite the same as I explained in the German DAX index here. We had a very unpleasant phase here at the end of this time period here. Maybe I should switch the color. At this period here, at the end of last year, where the cycle was pointing down and the markets moved up. So same what we observed more or less in all markets here. And now looking at the, now looking at the current situation, then we could argue we are now in sync here, but then it suggests that we should have topped here somewhere in April, May. I don't know if this counts as a sideways move, but if the cycle is active, there should follow a sharp down move into the period of September. So this is what we're waiting for if we still follow the cycle with a length of 170 something. We should now, or we need now, price projections to get a clue on when this cycle could have ended or will end from price projections. So we can use Fibonacci time projections here or Elliott wave counts to get a clue on the price projection. At least this cycle is very valid from a cycle analysis point of view. As we see it here in the spectrum, it clearly peaks out. So from the digital signal processing, the cycle is there. Okay, at least that's it for today. We did some live analysis for today. If you want to drop in some questions, so this is now the place and the time to do so. I will take a little bit the time to capture if you would like to join me here in this session. So I'm just waiting for the chat here. But until that, I hope you also enjoy our Saturday Science Cycles TV, where Ray, my colleague here at the Foundation, is looking at a different perspective on cycle analysis, more from the scientific point of view, where also very important aspects play a role. And the work of Ray and these colleagues might be very important to help us in solving the clue on the dynamics of cycles or other ideas how to detect the morphing of cycles ahead of time. So therefore, the work what Ray is doing is very, very important. And I think once this piece of the puzzle is solved, will also help us here in our digital signal processing to improve our work here. I just mentioned that because it's important that we put different disciplines here into the mix. Cycle analysis is not limited to what we are discussing here on Mondays. I think it's just one way to look on cycles, to use market data and use digital signal processing. There are different ways, so therefore I just can highly recommend the Saturday show where we will discuss different ways. And I think the best place to be here at the Foundation is that we put in all this knowledge we have on cycles to find answers for the still mysterious forces that trigger events. Okay, so let's get back to some of your questions, which are showing in. Eric, like you just mentioned, it is useful to include much longer cycles in the analysis. Is it possible to go over 400 days in the daily cycles, or can we only do it by using weekly data? Yeah, Eric, right. Good questions. Thanks for bringing this up. Right now, you need to move to weekly series to get longer term cycles. The scanner is more or less fixed to 400 days. If you want longer cycles, switch to the next higher time frame. In this case, weekly cycles or whatever time frame. That's right to use it. I would recommend use weekly or monthly data to detect longer cycles for this kind of cycles. Mike, Saturday reviewed the 160-minute cycle. Superb. Sometimes you could analyze markings or perks, harmonics of it. Yes, that's right. So this is then a shorter time frame, but at least, I mean, there are now different ways to do this. But I also would recommend to use the 2-hour chart, so the 120 minutes chart, and analyze cycles on this. This could give you a clue also when the shorter term cycles align. So I use weekly, daily, and 2-hour charts to analyze. I don't trade 2-hour charts. I should not talk about trading here, but the shorter term cycles help me to fine tune the daily analysis. Yeah, so I think on your primary time frame, for example, we are using daily here. Always use a longer term. So look for longer term cycles by using the next higher time frame. Eric, also what I try to explain. So if you go beyond 400 days, use weekly data series. Check what the cycles tells you there. And then I always recommend to align or to fine tune to the day, because if you use cycles with 170 days, you cannot fine tune the correct day or even not the week when the top or bottom might align. And therefore I recommend use a lower time frame, and I use the 2-hour time series to look on the 170-day cycle when the correct day might come. I use the 120 minutes, but for sure the 160 minutes, there are different reasonings why choose this time frame or that time frame, because the rhythm of the time might be aligned to other rhythms which happens outside, and if you align the rhythm, which, for example, there's also a 28-day cycle, so instead of monthly cycles, but that's beyond this cycle here. But Mike, just to answer, I would recommend, if you use it in your trading environment, put your own intraday data into it. I would not go down to 5-minute or even 1 minute or 10-minute. If you look at the daily, use the 2-hour or 4-hour series to fine-tune longer term daily cycles. And yes, this brings me to a topic. I owe you a longer series here on the show on intraday cycles, which is still in the making. Don't get me wrong. I just need time to finish on that. Okay, so I would call it a day for today. So thanks for joining me again here live on the session. This is what I like, to have some live comments and discuss it. So please do this again next Monday to meet here. And I will be back here next Monday. Send me your questions or drop in your comments below the video. Thanks for staying with us today, and see you next week. Bye.